This course is not intended to be a course in bookkeeping. However, bookkeeping is done for every economic entity: a company, a church or nonprofit, a government agency, federal, state, or local. This program is, in fact, a college-level course in financial accounting. In the college-level course, we introduce the accounting cycle. What does that mean? Well, we are going to start a company and create a set of books. It is important to manage a set of books so we can see the information flow in accounting. We will record journal entries, post journal entries to T accounts or ledgers, record adjusting entries, create a trial balance, prepare financial statements, record closing entries, prepare post-closing trial balance, and finally, prepare opening financial statements for a new accounting period. Getting back to Luca Pacioli's double entry system of accounts, we have journal entries to record economic transactions, recognizing the duality of economic transactions. A journal entry has a date, a journal entry number, a debit, a credit entry, and an explanation. Here we record the investment by the owner of the business. The business receives cash of $10,000, a debit, and issues common stock of $10,000, a claim of an owner, a credit. There has been no improvement in double entry bookkeeping in the 500 years since Pacioli created his system for the Medici family of Renaissance Italy. In this slide, we have the journal entry and a posting to a T account or ledger. We use T accounts because they have a debit and credit side, which is a ledger in short form. When books were prepared manually, journal entries were posted to ledgers where debits and credits were recorded. A T account is a ledger in short form. In our posting of the journal entry to record the investment by the owner, we see the journal entry number JE1 with a debit to the cash T account and a credit to the common stock T account. We increased an asset account, cash, and increased an equity account, common stock. In this slide, we record journal entry 2 with a debit to cash, an increase, and a credit to notes payable, a liability, and an increase in liabilities. Receipt of cash, $2,000, a debit. Creation of note payable, a liability, a credit for $2,000. Notice that in the case of cash, the normal balance is a debit. In the case of notes payable, the normal balance is a credit. Accordingly, debits do not mean good, and credits do not mean bad, or any such thing. Here, debit means left and credit means right. In the case of cash, a debit or entry on the left side of the cash account means increase. In the case of notes payable, an entry on the right side of the T account is an increase in notes payable. Debit means left and credit means right. In journal entry 3, the company buys inventory, an asset, and records a debit in the inventory account, an increase of $8,000. The merchandise was bought on account, that is, no cash was paid. Instead, we have a credit to accounts payable, a credit for $8,000, which is an increase in a liability. Assets up, debt up. Accounts payable records the claim of a vendor who sold the merchandise to our company. Merchandise, an asset, yep. Accounts payable, a liability, and yep. In JE4, equipment is purchased for $4,000. Equipment is an asset, so we increase it with a debit. Cash is used to pay for the equipment, so we lower cash by $4,000 with a credit. Equipment up, cash down. In JE5, sales are made on account. That is to say, we have offered terms to customers, and correspondingly, they paid nothing at the point of sale. We debit accounts receivable, a current asset, increasing it by $9,000, and we credit sales by $9,000, increasing it. Accounts receivable up, sales up. The sale means that either the company delivered as a service to customers or sold a product, but did not collect cash on the date of the sale. Here we see the T accounts for the balance sheet accounts and the income statement accounts. we see cash increased by $10,000 and common stock increased by $10,000. Then JE2, increasing cash for $10,000 and a credit to notes payable for $10,000. JE3, we acquire $8,000 in inventory, a debit, and we credit accounts payable for $8,000, a credit, and an increase in accounts payable. In JE4, we acquire equipment with a debit for $4,000 and we credit cash, decreasing it. In JE5, we debit accounts receivable, an asset for $9,000, an increase, and we credit sales, an increase by $9,000. Now let us consider, it would appear that the balance sheet has more debits than credits. That is because JE5 had a credit to sales, which is an income statement account, in the amount of $9,000. Later in this chapter, we will record closing entries, at which time revenues will be transferred to an equity account, an increase, and expenses will lower the equity account. We could say that revenue represents an increase in equity and expenses represent a decrease in equity. Here, we review the first 5 journal entries. On display is Pacioli's duality of economic events. For every debit, there is a corresponding credit, and debit-credit equality is maintained. In JE6, sales commissions are paid for $800. We debit sales commissions, an increased expense, and we credit cash, an asset, lowering cash by $800. Expense up, cash down. In JE7, we pay administrative expenses, a debit, and credit cash for $700. The credit to cash lowers assets. And the debit to admin expense will ultimately lower equity, specifically retained earnings, an equity account. We will see the change in retained earnings when we see the video on closing entries. In JE8, we collect $4,000 from customers. The revenue was recognized in JE5 when the goods or services were delivered. Here, we debit cash, an increase, and we credit accounts receivable by $4,000, a decrease in an asset account. In JE9, we pay $5,000 to vendors. We debit accounts payable by $5,000, lowering a liability, and we credit cash, lowering an asset account. Assets down, liabilities down. In JE10, we receive cash from a customer for $2,000, a debit to cash, and we credit unearned revenue for $2,000. Unearned revenue is a liability account. Because we have not yet performed a service or delivered goods, we record the event of the cash receipt as unearned revenue. Cash up, liabilities up,